In recent months, we've seen an unexpected geopolitical conflict spike oil prices globally. A quick market correction, concerns over sticky inflation in the U.S., and despite it all, equities have continued to hit record highs. With all the tumult, investors are now wondering what comes next. I'm Chris Heisey, Chief Investment Officer for Merrill and Bank of America Private Bank. Here with me to share his always essential perspective is Michael Hartnett, Chief Investment Strategist for B of A Global Research. Michael, thanks for joining me today.
Pleasure.
I want to start at what you've been asked probably every meeting. Let's start in the Middle East. Let's go right there. And how is that impacting markets? What do you think investors around the world are thinking about right now?
Well, I think that the overall impact of what's going on in the Middle East is a world that's very different this decade to previous decades. The previous decades, we tried to get right by getting demand right. You know, how much people spend, where they're spending it. But this decade is all about supply. You know, and whether it's COVID, whether it's trade wars, whether it's, you know, what's going on in the Middle East, I think what investors are getting to the conclusion is you have to own what is in scarce supply. It could be semiconductors, it could be rare earths, it could be oil, it could be, you know, minerals. You know, this is what this world is telling you, because you have right now, I think, a big war. It's not the one in the Middle East. The big war is China, US, AI. And so if you think about US foreign policy right now, to me, what US foreign policy is trying to get or achieve is dominating the supply of the stuff that will win that war. And so I think part of why investors, I'm not saying that they're relaxed about the situation, but certainly where they are very willing to put money is in these areas, whether it's, you know, semiconductors, whether it's commodities, where they believe that there is scarce supply and big demand going forward.
And when you talk about that shift from a demand-driven environment, that goes back to well before the pandemic too, right? All the way back to the global financial crisis, trying to induce demand. How has that affected, you know, globalization?
Yeah, I think that the globalization story really started with the fall of the Berlin Wall, you know, and then it was followed with NAFTA, and then it was followed in 2001 with the China joining the WTO. And you look at those periods and it was wonderful for equities, but also wonderful for bonds. You know, because what was happening was there was this massive increase of supply of people, of capital, of goods, of services, and that supply, because it was big, led to a fall in prices. The fall in yields led to a rise in equities. I think you fast forward to Brexit, you know, Trump's first, you know, trade war, you know, even, you know, some of Biden's policies, you know, Trump, you know, 2.0. I think you're in a world which is much less global. You know, what you think about the Strait of Hormuz and people, you know, the Iranians, Americans negotiating over, we're going to charge a toll. You've got to pay to go through that. I mean, if you're Indonesia, Strait of Malacca, why aren't you doing the same thing? Sea of Japan, you know, English Channel. I mean, where does it stop? You're restricting the supply. And in doing so, you're raising the price of that thing. That creates inflation. Doesn't necessarily mean that equities go down, because, you know, inflation can be quite good for profits. But it does mean, as we've seen in the 2020s, that equities go up with bond yields going up, not going down. Do you see what I mean? So the situation for the bond market is very different because of this supply.
So let's talk about the bond market for a second. Credit spreads are narrow. There's a lot of concern in the private credit market. There's a lot of concern about growth overall. Can it be sustained at the level that it is? There's concern about inflation. You mentioned that before. Why is the bond market saying, not my worry?
Well, there's two bond markets. You know, you talk about credit spreads. That's because people are happy to own a corporate bond. What they're less happy to do is own a government bond. You know, the government,
particularly the long end is what you're talking about.
That's right, but it could be, you know, US, Japan, UK, I mean, there's lots of government bond markets where investors are looking at the government and saying, you're not going to cut spending. You're not going to reduce, debt. You're going to continue to run, big deficits. In addition to that, because investors, we watch, we listen. Yeah. And what we see across this world is electorates, voters, who are not voting for a balanced budget. I mean, you think the 2028 election in the US is going to be fought by two candidates saying, I'm going to balance the budget? It's just not. So bond investors are saying that situation is not going to improve. The risk with that is at some point people lose patience and say the debts and the deficits are just growing too much, and you get a big spike in yields. And that obviously can be very, very dangerous so far as equities and corporate bonds are concerned.
We've talked about geopolitical events. There's still one going on with Russia and Ukraine.
Yep.
Arguably speaking, we're getting used to the fact that geopolitical risk is not only elevated, it's staying elevated. You've got a commodity cycle going on right now that you've talked about quite a bit. Worries over inflation, deficits are wide, trying to build a balanced portfolio. Just sitting here now and thinking through the next 3, 4, 5 years, what's the opportunity set look like across the asset classes from your perspective?
The corporate bonds are at all-time highs. The equities are at all-time highs. The government bonds are down 50% in 5 years. Yeah. So clearly, I have to say, if you were a secular contrarian, you would be owning, at least starting to buy the long end. There will be an opportunity in bonds at some point in the next 5 years. I don't know whether it's today or after the midterms, but there will be one coming. An easier case to make right now is the asset class that has actually outperformed this decade, albeit because of gold, which is commodities. And I think what you'll find in the second half of the decade is that the commodity bull market will broaden into metals and into energy. And I think those are areas I think that you could build weightings in. Together with that, in equities, again, the first half of the decade, equities did well, but again, it was very built on US equities, US tech, US mega cap. And I'm a big believer, as been the case for the past year or two, that you will see that broaden first into international markets, and I think we've seen that. Europe, Japan, Korea, but also emerging markets. Yeah. I think China is the big opportunity, going forward from here. But also I think that the size story will change. Again, mega caps have done very well. The Magnificent Seven has been magnificent. But it's been magnificent and was originally magnificent because people looked at that group and say they make magnificent amounts of money, cash, and they don't spend any of it.
Yeah, right.
Now they're spending all of it and more in this AI CapEx arms race. They're not going to outperform to the degree that they have. And again, like you said earlier on, the bond market will regulate the amount that they're allowed to sort of spend in that regard. I think the story will be more the small, the mid-cap, and I also think the consumer will do better in the next 3-4 years. I think the consumer, because I think you need to see politicians address inequality. They need to get on top of like consumer price inflation. And I think if they can address affordability in a smart way, I think the consumer comes into play. And those 2 or 3 things have underperformed in the first half of the decade, and I think they'll outperform in the second.
The final question I have for you is, what excites you about the next 5 years from an investing standpoint?
Well, I think number 1, commodities. Number 2, emerging markets. Number 3, the consumer. I think the chips story, the semiconductor story, it's very, very overbought right now today. Very, very overbought. Those stocks are the most overbought they've been, I think, since the year 2000. So that needs to calm down a bit. But I would say, chips, consumer, commodities, China, those are the C's that I think, money does grow on seas. I think those are the things that will work in your portfolio going forward. I think the thing that won't is probably the US dollar. I think there will be an opportunity to buy the long end. I think, bonds did well in 2025. I worry a little bit in 26 with the midterms. That won't be the case, but I think you have to be a little bit patient in terms of that allocation.
That's great, Michael. Thanks for joining me today.
Pleasure.
So much to unpack there. We went around the world. We talked about concerns and the larger opportunity set we see unfolding over the next few years. And always stay the course through volatility with a balanced portfolio. And remember this, staying diversified is so important to your long-term financial goals. If you have questions about how to align your strategy in times of volatility, consult with your advisor if you work with one. We'll see you next time.